Will you afford to retire? How good or how bad is the Belgian pension system compared to other systems in Europe? This is the second talk of Belgium Money Week 2025, where I interview Sébastien Commain, co-author of the report Will You Afford to Retire by BETTERFinance. Every year, BETTERFinance, which is the European Federation of Investors and Financial Services Users, publishes the report called Will You Afford to Retire? It's a detailed analysis of private retirement savings plans in the various EU member states, including Belgium. The report highlights the charges, the taxation, the returns, and other key parameters of pension savings to determine whether or not they are really helping to achieve pension adequacy for individual citizen contributors like you and me. The report stands out as the sole publication that calculates the real net returns and tackles the questions of purchasing power for retirees. In this talk, you will learn about the challenges faced by our system in Belgium, with a special focus on pension products from Pillar 2 and 3. You will learn about their net returns and why they are so low. You will also learn about one striking example of a pension product in Europe that delivers very high returns and completely dwarfs the performance of all other examples in Europe. And finally, you will learn about what you as an individual saver and investor can do to invest better and better prepare for your pension. By the way, my name is Sébastien Aguilar and I'm the founder of FIRE Belgium, where I help people take control of their finances and learn to prepare for their pension through evidence-based passive index investing optimized for Belgian taxes. I explain everything in the free workshop on the FIRE Belgium website, firebelgium.com/investing workshop. And now, let's learn from Sébastien Commain. Here we go. Welcome everyone to the second talk of Belgium Money Week 2025. Today we're speaking with Sébastien Commain, who's a Senior Research and Policy Officer at BETTERFinance. And we're going to speak about whether we will be able to afford to retire. Sébastien, thank you so much for joining us. Welcome. It's a pleasure to have you. And we'll right straight into the core of the topic. We'd love to hear from you then. Where does this report come from and what does it include and what are we going to talk about today?
Where it comes from, actually, it's a long story. It started basically at the same time as BETTERFinance. BETTERFinance was founded in 2009, just after the global financial crisis, because as a reaction to the number of abuses and misinformation, mis-selling cases of financial products to retail investors. And part of its remit, I mean, in the defending the interest of retail investors in EU policymaking, was also focusing on, that big channel of retail investments that are pension funds, long-term savings. And the idea of the finance management at the time was we need data to show the actual performance of those products that are sold to basically every European household as a key for good retirement income, as absolutely necessary to support them in retirement. And gathering the data, they realized that no, it actually doesn't work because performance is not there. And that has been the unfailing conclusion for all those editions to this year, that returns are not sufficient in most cases. Now, there are a few exceptions, and I will come to that later, but the idea was really to put figures on the argument that we need better returns as the costs and inflation are eating away the performance of those products. And we need to be informed of that. We need to raise awareness of that. So since those, that first edition of these 3 countries, now it has expanded. We cover 16 countries. We used to cover 17 countries, but we have too many difficulties finding data about Bulgaria, even more than in Belgium. So we had to give up on Bulgaria. The idea would be to cover all EU member states so that we can really give EU policymakers an overview of, the state of the pension system across the EU with national specificities. Now, we are kind of pursuing a double objective with this report. One is to really provide evidence to policymakers and make recommendations for changing the EU level regulation, legislation, and also the national legislative framework on pensions so that we can have higher performance, lower cost, better outcome generally for pension savers. And the other is also to inform individual investors, pension savers about what is the pension system in their country, what they can expect, the three pillar structure that you described a couple of minutes ago. Most people don't know about that, and they usually do not know in their country which organization, which institution is in charge of the public pension, the complementary pension. They don't know the difference between a life insurance and a pension fund. So, it's useful to provide details on all that. Part of the history of this report also is that they started that, Prash, especially the founder of BETTERFinance, with the view to push the supervisory authorities at the EU level to start their own cost and performance assessment of investment funds and pension savings. And now the EIOPA is doing that for life insurance and pensions, and ESMA is doing that for investment funds. Now, they don't do exactly the same. We try to cover all providers in a country. They take a sample approach. We used to be the only ones calculating real return after inflation. Now they do. So slowly, we are pushing them to actually provide a realistic overview of the performance of those pensions. Now, one thing I've come to realize, working a lot on this report, is that pursuing this double objective of using those data for advocacy to policymakers and information to individual investors is an impossible task. I mean, it's either too complicated for individual investors or too simplistic for policymakers. So, in the recent years, what we're trying to do is get data that is as accurate, as detailed as possible for the report, and then try to use that to create educational materials, interactive tools to inform people. But that's what I'm working on, developing a database that can be used to inform people in a more interactive and a bit more user-friendly way than the 500 pages documents that we used to produce.
Yeah, okay. It's good to see that you've made so much progress, and it's certainly something that's needed, because unless someone looks at it, then there's no real accountability for performance. And we need that. Otherwise, especially because it's related to the private sector, there's no incentive to improve, the outcome and basically the pension benefits for savers.
Yeah, I can tell you the financial industry doesn't like this report at all.
No, they don't. And part of the reason I'm interviewing you guys is because people need to know about the results of your report. As someone who does not rely much on the pension system and really, I've built most of my wealth and my pension system based on index investing, so it's Pillar 4. I've realized then how inefficient Pillar 2 and Pillar 3 products can be. And so certainly it has helped me communicate on the need for change and the need for improvement. And I think from that perspective, your report is doing great. I mean, I even brought the results of your report to the television. I was on TV, I think 2-3 years ago for Money Week on LN24, and I was using some of the data from your report to show that it's not just about, savers who have to save and contribute more, right? Because in fact, the political discourse and basically everyone from the industry tells people all you have to do is save more and contribute more, have more products, and keep putting more money in so that you have a better pension. And that's part of the message, because for sure high contributions will lead to better pension in the future, but it's not enough, because if the system is inefficient, then it's only half the solution. Like the other half is improve the system, make the system more cost effective, so that there's more benefit for the same amount of contribution. And that's something that is rarely spoken about. And I think your report brings us, like people like me, the tools to be able to say, hey, yes, it's good to encourage people to save more and contribute more into those pension plans, but it's not just on them, it's also the system, right? So we need to challenge both yeah, the savers and so the people who are working and saving and putting money aside. And we have to challenge the system, the insurance companies and the pension fund management companies to provide better returns, to provide better products.
Yeah, that's our feelings exactly. And it's really what we've been telling, at least for the 2 years in which I've been at Better Finance, and I think for many years before, that telling people to start investing early and invest as much as they can is necessary. It's a good message. But if those savings do not yield sufficient return and do not beat inflation, then you're losing purchasing power anyway. So it's not a better deal than just doing nothing or putting money under your mattress. So yeah, we need to talk about the efficiency of the European financial system in generating wealth, in creating wealth based on those savings, and not just into accumulating them. And that's, I think, a very topical issue nowadays at the EU level and also at the Belgian level. At the EU level, we've been discussing for the past 2 years a retail investment strategy that is a lot about value for money, how to make more transparency, how to get inefficient products out of the market. Not going very well, I have to tell. And now we all, as the new talk in town is savings and investments. We want to channel household savings and especially pension savings into equity of European firms. Very good, but how are those channels efficient, cost efficient in a way that makes those investment opportunities good investment opportunities?
Yeah, so in the community that I'm in, so in the FIRE community, the index investing community, a lot of people are of the opinion that in fact it's better to not contribute anything in those pension savings plan and pension products because they're such low performance compared to a simple portfolio of index funds, which with a bit of knowledge is not complicated to set up. And so there's this lack of transparency, there's this lack of trust now that's growing. And so, yeah, there's work to do because this needs to be fixed. Actually, 99% of people, they need this system to get better because not everyone is going to learn to invest in index funds or is going to start investing in this way or can even, find the ways to save enough to do that. So there's a need for improvement. Certainly, that's something that I want to contribute to. And the community, I think, is supportive of helping the pension system get better because, in fact, everyone in the community will benefit from it too, right?
Yeah.
So that's the direction we're going in. But let's jump into the questions that we have prepared for this. I guess the first one is like, how is the Belgian pension system and how does it compare to other systems in Europe?
I think generally, I think Belgium, of all the countries we analyze, is a very typical Western European pension system. I think it has a large public pension system that until now provides most of the retirement income for Belgian residents. I mean, most of us of pensioners, current pensioners, rely essentially on their public pension. It works, so this public pension, we've talked about it yesterday, but it works as a pay-as-you-go principle. So the current workforce pays for the current pensioners. There is no accumulation, there is no pre-funding of pensions. That also means that nowadays it's under threat due to the aging population, the pressure to reduce public deficits, this imbalance, the growing imbalance between contributions and payouts is increasingly difficult to bear for public finances. Then we have an occupational pension pillar, so workplace pillar, paid in by employers or sectors on behalf of employees that covers a large majority of the Belgian workforce. I think we're around 85, 86% of workers in Belgium covered by an occupational pension plan, which compared to other countries like, say, France, is incredibly large. It's not as important as in the Netherlands, where basically the occupational pensions are universal, but in Belgium, it's near universal. What we're missing at the moment are essentially the self-employed, the independents, who have different systems but are not automatically covered by occupational pensions. And then we have a more limited but still quite important pillar of voluntary pension. So that's what everybody in Belgium knows, your life insurance with branch 21 or 23, your pension saving funds that you as an individual subscribe to. Maybe I can show quickly just a pie chart of what, the distribution of those savings. So you see, it's the largest part of those pension savings, supplementary pension savings, are in assurance group, so occupational pension plan of the branch 21 with a capital guarantee. Then we have a small slice of branch 23, also collective insurance, but without a capital guarantee. IOPS, so that's occupational pension funds. And the yellow and orange parts are the voluntary pensions, so the ones that we as individuals take on top of that. So it's roughly 1/3 for the voluntary pensions, 2/3 for the occupational pensions. That's where you realize, since the occupational pensions are automatically set up for you, see that the Belgian workers actually, save a lot without even knowing about it. They automatically save for the pension without thinking about it, without knowing about it, but also without any control of it. So that's part of the big issue, and that's also part of why we at BETTERFinance produce these reports, because somebody has to talk about the returns of those pensions. I don't know about you, but I, as an employee, and my executive director is in the audience, so I should be careful what I say. But I've never seen with any of my employer any pension benefit statements, actual track record of performance of those plans.
Yeah, or any forecast of what it could mean in a couple of decades or something.
Yeah.
And so I was wondering, so in this diagram, you show that there are pensions products that are group insurance, branch 21. These are mostly then bonds related pension funds. Then branch 23 is usually a mix of equity and bonds. And then we have IORPS. These are fund management companies that manage pension funds. So these are invested also in the stock market or bond market.
It really depends on which institut de retraite professionnelle. They invest half of their assets in bonds, usually, and 1/3 in equity, and the rest in real estate, investment funds. But they are still investing quite conservatively, not as conservatively as branch 21 insurance, but still, not exposing to too much risk. We'll probably come back to that.
Yeah.
Now, to come back to your first question about, how does the Belgian system compare to other ones? I think you can say that Belgian system is really a real-world embodiment of the World Bank multi-pillar model. What you described was 4 pillars or even 5 pillars. Sometimes we talk about pillar 0 of the pension systems. You have those, distribution of pension savings across public pensions, occupational, voluntary pensions, and additional savings that are not specifically earmarked for pensions, but are still usable for that. And you have those two big types of providers that exist nearly in all, at least Western European pension systems, that are life insurers, it's the biggest part, and pension funds, or occupational or voluntary pension funds. Now, that's not the case to all the countries. If you look at France, for instance, occupational pensions are nearly in existence. They are very little. And most of pension savings are actually in voluntary life insurance. In the Netherlands is the exact opposite. Life insurance virtually doesn't exist. It's an enormous pot of occupational pensions in pension funds with a mandatory system of contributions. And in the eastern half of the European Union, you have very little life insurance, and you have mandatory and voluntary pension funds. So Belgium is kind of, has a mixed approach to that. It's good or bad in terms of, providing adequate pensions. I think it's also probably, unfortunately, a rather typical case, because we have public pensions that replace on average 61% of pre-retirement earnings. That's slightly lower than the OECD and EU averages. But if you add those supplementary occupational pensions, when we reach a replacement rate of 74%, that means that the average Belgian worker can expect their pension, mandatory plus voluntary, to cover 3/4 of what they earned in the latest year of their careers. It's not so bad.
Yeah.
Actually, yeah, quite good levels. That's below the Netherlands and Luxembourg, but that's above France and Germany. So, for once, can be happy.
So that's the average. Obviously, average is always a tricky measure. Is the median very different? Do we have like very high earners with high pensions and low earners with lower pensions and maybe a lower replacement rate, or is the higher replacement rate for lower earners? Like how?
So that's data from the OECD. They don't publish the median, but it would be very interesting. What they publish though is the replacement rate for earners with 50% of the average wage, and the same statistic would for 200% of the average wage, so high and low income workers. And the replacement rate tend to be higher for low income and average income than for higher income.
Okay. Yeah, that makes sense also. I think it's also what Pierre mentioned, I think, in a different presentation, not yesterday. But replacement rate is actually better for lower income because the calculation for the first pillar is made so that there is redistribution and reduction of inequalities and basically providing some sort of a minimum level of income to be able to sustain oneself. And so higher earners, if they want to bridge that gap, then they have to use additional like supplementary pensions, so pillar 2 and 3, right?
I think generally when you think of the specific purpose of each of the pillars of the pension system, you go from the pillar 1, the public pension that has to ensure a decent or at least basic pension to everybody, even those with career interruptions, especially women, that has to tend to stop for caring for the children, for the elderly, not at 100% equal society and that matters. So there is still a big, income gap between men and women, and the public pensions tend to be better equipped to compensate for that. And then the higher you move into, the scale of income, and the more you rely on the pillar 2, pillar 3, and then pillar 4 of pensions, because the social purpose is really concentrated in pillar 1 and a bit in pillar 2. Then the rest is, since you can save, it's your responsibility to save, and that's pillar 3, pillar 4.
Yeah, that makes sense. Yeah. Okay, so what are the key challenges in the pension system in Belgium? What are the weaknesses?
I would always start with the lack of information and lack of transparency. I mean, it's especially striking in Belgium that there is very little information about pension, about occupational pension, even more about voluntary pensions. And it's a big problem, a big challenge, because you cannot make informed decisions about your pension savings, about your retirement planning, without reliable and comprehensive data about the real performance of your pension. At the moment, what do we have? We have mypension.be, which is a good tool, to understand your public pension. It has basic information, but it has good projections saying, here are the assumptions that we made to calculate your pensions at the time of your retirement. Here's the date when you could take your retirement. Of course, barring any change in legislation, that there will definitely be. But, it's presented clearly. It gives you a good idea of how much you are likely to get from the public pension. But then when we move to supplementary pensions, first, we don't have anything on voluntary pensions. There is no pillar 3 in mypension.be.
Pillar 2, yes? Or
Pillar 2, yes. Okay. If I go to my account, I can see, the occupational savings made by my 3 employers in Belgium. but with a long delay because the latest data I can get for my case is January 2024. So I don't really understand how in the age of blockchain and artificial intelligence, it can take so much time to actually give me this balance of my occupational savings, but okay. So it really only provides information about occupational pensions, and it does that in a very segmented way. So once you've got your mark in the public pension part of the site, then you move to the occupational pension, it looks completely different. You've got only the total reserves accumulated in occupational pension at this time, but no track record of the performance. You don't see what's the evolution. You don't get to see how much of those total reserves is a result of investment returns versus what has been paid in by your employer. You have no indication of the annual accumulated costs of these plans. Is your employer actually making good choices for your pension? You can't. And it's even unclear whether the amounts that are communicated are gross or net of costs, and let alone adjusted for inflation. Not talking about inflation. So
Okay, so you get one number, but no information about what it means.
yeah.
Okay.
Now I see a comment from David Yejois. And indeed, for voluntary pension, you would have to go to your, the app, the portal of your provider. But my point is, if we really want people to get to start planning for their retirement, they need a holistic view of their future financial situation. And for that, we need to aggregate as much data as possible. At the moment, there are projects at the European Union level to create what we call open finance. It's a big name. The idea of open finance is really to make the possibility to have all your financial data gathered in one aggregator. We have our misgivings with that, especially when you trust financial intermediaries to create that for you. But the idea is really that we want that information on supplementary pension, voluntary pension, to also join this overview of your pension. If the name of the site is My Pension, then it should not be just public and occupational, it should be all of your pension.
So that's the big first challenge is transparency and access to information, because that's obviously why we're doing what we're doing today, trying to clarify how this works. And even mypension.be, which has been, touted as this is the solution, is still lacking. What are the other challenges?
The second big challenge is the allocation of assets. We already touched upon that with branch 21, but for now, those supplementary pensions, they are for very, very large parts invested in assets that are really safe bets. They are very stable, very safe. There is very little volatility. But if you lock those savings for 20, 30 years for the time of your career, you actually don't care. And that's something that needs to be explained to people, that this annual minimum, this minimum return guarantee on your annual performance is meaningless. What you should have is a minimum return guarantee over the life of your contract. At the time of your retirement, this is a minimum return that you should have. Because the main risk of pension savings is actually not losing 20% next year. It's losing 20% of the purchasing value of your accumulated savings at the time of your retirement. It's not the case in Belgium. I think we see net returns, real net returns after inflation, that are still positive for the long term. But there are countries and there are pension savings products in Europe that do return a loss of minus 15, minus 20%. So, when we say invest safely, is actually invest something that at the time of your retirement and beyond will have increased the value of your savings. So we would say, generally we say at the EU level, increase the exposure of equity for as long as we can during the accumulation phase, so long time of your career. And then a few years before your retirement age, reduce this exposure to stabilize your savings, get something safer, more stable. In the case of Belgium, the idea would really be drop branch 21 guarantee. We need to have more exposure, more investments directed to equity, to those assets that have a cash flow that can actually beat inflation, which is not the case of bonds, and especially not government bonds. Now, this guarantee, it makes sense for your rainy day fund, for your savings accounts, because you may need to draw from it for unexpected expense. It does not make sense for savings that you have willingly locked for a decade or more.
So this is the second challenge. I think it's very, very important. Let me just quickly jump on this. Yes, the fact that a huge amount of all these retirement savings is locked in bonds for decades, when for a very long time bonds have had very, very low returns, is a complete nonsense, right? I think we're clear on that. And that is due to the fact that there is a guaranteed annual return that is imposed on one side is the insurance companies, but for branch 23, which are supposed to have a big chunk of equity, that my understanding is that the risk is borne by the employer. So the employer has almost no interest in taking anything that is heavy in equities because the risk would be borne by him. Does that make sense? Is that correct?
It's my understanding, yes. No, it's for branch 21, but the employers can be.
I was just reading this in the report and I was like, it's
No,
crazy. So branch 51, it makes sense that there's a guarantee. I mean, almost makes sense, no? Because it's supposed to be equity, sorry, fixed income and bonds. But branch 23, from what I read in the report, is also benefits from the guaranteed returns. But in the case, but so no, so it's not borne by the fund management, but the beneficiary benefits from the guaranteed return, and that then the risk is borne and the difference has to be paid by the employer, which basically leads a lot of employers to not go for anything fancy or appropriate. In fact, it's not even fancy, it's not appropriate, is they go for something that's very safe and so heavy in bonds again, which makes it so that the large majority, well, so there's two reasons I think that a lot of money goes into bonds. Is one, people who are putting money away for the pension, and generally people think, oh, we just want to be safe, right? We're not here to take risks, so we stay away from equity. But the other driver is that there is a guaranteed return that needs to be met, and that you can only guarantee it on a year after year basis if you have bonds with that kind of interest. And so there's basically the incentives are both mindset based. It's like, oh, we don't want to take risk with this because we're not in the business of taking risk with this. And so that's why there's all this insurance stuff. And the other one is there's also a constraint that makes it so that employers have no interest in picking pension funds that would be more beneficial for their employees because they are bearing the risks, or at least part of it. And so this leads to a lot of money being stuck in the wrong type of asset, which, if we could fix just that one thing, we could probably make the pension system much better in Belgium. And as you're saying, so branch 21 seems to already make no sense because they're heavy in fixed income. And as index investor, we all agree with this because that's how we manage our own investment. Is for a long time we are heavy in equities, and when we get close to retirement, then we switch gradually to bonds and fixed income. And even we don't go heavy; we just gradually increase. And it seems that the same approach should be used for pensions. My understanding.
Exactly.
So before we go to the third challenge, there are some countries where that is already implemented, right? Where they have a system which is heavy in equities throughout the accumulation phase, and then towards the end or in the transition, and then withdrawal phase of the accumulation, then moves into bonds. Are there some examples of this?
There are some examples with that. Maybe when we talk about the actual returns of pension plans in Belgium, I will show a graph showing the situation in Sweden, which is very interesting. But yes, there are countries where you have purely defined contribution schemes with no capital guarantee, no solidarity clause. So it's really making your pension savings depend, the value of your pension savings dependent on the evolution of the market, and especially equity markets. Now, what we see is that the most successful pension savings products, pension savings schemes, are actually the ones that implement a life cycling approach. So those that invest your savings fully in equity funds for basically until 10 years of your retirement, and then slowly, progressively move parts of that accumulated pot into bonds to stabilize, so that at the time of your retirement, you still have a part in equity that generates more wealth, that keeps growing, but still you can draw, you can expect your withdrawals to be there, to be available when you need to draw from your retirement savings. Now, the absolute example that we take in the report is Sweden AP7 sulfur. So it's a pillar 1 bis type of pension. So the pillar that we have not talked about yet, but it's basically an occupational pension fund managed by the state and funded out of social security contributions. But yeah, that's the approach we take. If we have only 2 funds, 1 equity, 1 bonds, you have your individual account with them. They keep all your savings into the equity funds until 10 years of your retirement, then move 2/3, progressively 2/3 into the bond fund. And throughout your retirement, they still keep 1/3 into equity so that your retirement savings keep generating wealth. And the returns on that fund, those funds, is incredible. It raises questions, honestly, in terms of the risk-taking of the investment strategy, the leverage, the equity fund. So, there are criticisms that we might actually be taking too much risk to generate those returns. But still, between those sky-high returns and what we see in most European countries, there is definitely room for improvement. Another solution that starts being implemented, but private providers and some members that are not really willing to have it take off, is a pan-European pension product. It also implements a life cycling approach with the same idea of maximizing your exposure to equity as long as you don't need to touch to withdraw funds from your retirement savings. And when you're near retirement and your need for security, stability increases, then it moves your savings to more stable assets, more guaranteed assets.
So
And they do all that at very low costs.
this is the PEP.
Yeah, the PEP.
Okay. Yeah, and is this being implemented in some European countries? In Belgium, there's not much going on, but
actually, my check was a few weeks ago, and there was still only 1 provider in Europe, which is based in Slovakia, and they offer the PEP in 4 countries: Poland, Slovakia, and I always forget the other 2. Sorry for them. But it's now there are a lot of discussions on how to make the PEP more attractive, probably simpler, easier, less costly for providers to offer on different markets, but also to push member states to actually give it the same tax treatment.
yes, that's
as
the issue with
others.
Belgium, right? There's no tax incentive to get something like this.
Yeah.
Okay, so that's 3 challenges. I think we had transparency and lack of information, the constraints and unguaranteed annual returns. What we just discussed. This one what's the third again?
I think the third is really the costs, the high cost pension saving products. I mean, it's extremely difficult to compare costs across countries, even across segments of supplementary pensions. And so when we look at the data published by FSMA on supplementary pensions, the figures of cost are staggering, especially when you compare with the actual returns on those investments. It does cost a lot to lose money. For branch 21 products, generally you have quite low asset annual fees for the management of your asset. Makes sense because it's quite simple to invest in government bonds. Doesn't cost a lot. It's not really, there's no really cost of active management for that. But you have very high entry fees. You pay a lot on each of your contribution to those funds. And the average, if I remember correctly, the FSMA report, they updated that in January this year. So for data for 2022, I think the average entry fee for range 21 assurance group was 6%.
Wow, okay, yeah.
Yeah. Now the asset management fees are at 0.05%, so it's very low.
Okay.
For branch 23, you have quite the opposite. I mean, the entry fees are lower, not cheap, though, still in the range of 1.5 to 2.5%.
Yeah. More like bank funds.
Yeah. And then you have the ongoing cost of asset management, which are mostly, due to the fact that those are unit linked, so you have to pay for the management of the funds. So, overall, it's not particularly cheap, but if you were to have good returns based on that, or high performance, that would be acceptable. And we have products in our sample that have higher costs, but also higher performance. And we have products that have a higher cost and lower performance. So it's, in that case, also, Belgium is quite typical. Now, when we look at pension funds, whether occupational or
So I'm not sure did you share the average asset management fee for branch 23? I don't think I caught that.
No.
Or like some sense, like are we talking about 0.5%, 3%? What's the
I have it somewhere.
okay.
Not bad. It's asset management fees for branch 23. I think in the area of 2.5%.
Okay, that's quite high still, yeah.
So, yeah, especially if you compare with ETFs.
Yes, all right. And then we have pension funds, right?
Yeah, pension funds are, if you compare them to assurance group or life insurance in general in Belgium, they look cheap. I mean, they are not particularly cheap in absolute terms, but they have a bit, costs performance balance than assurance or life insurance, which is again something quite typical from what we see. Life insurance in Europe in general is not performant. It's more costly, and the long-term performance is lower than pension funds. And that's the case in all the countries that we look at that have a life insurance segment. It's usually more expensive, in part because it adds, guarantees that are costly, but do not show up in terms of performance, of long-term performance. So it can be, biometric risk coverage, death coverage might be useful in many cases. People would ask for that. But we also see many cases where people are sold unnecessary guarantees. Because, if you are perfectly healthy in your 20s and you invest in life insurance that covers you for old age disability, that might come handy in your old age, but you would pay for that for 30 years before it becomes useful. So, it adds a drag on performance. Now, I think when we see, this cost and the, number of providers, the distribution of the different levels of cost, I would say again, Belgium is quite a typical case. We don't have so much competition between pension plan providers. They are more expensive, less expensive, but generally, few providers, a very concentrated distribution system. You have distributors of the insurers that sell you your life insurance plan, and very opaque cost structures, and all that enables providers to inflate costs at the expense of pension savers, because all you pay in costs is money that will not be invested to generate more returns.
So talking about returns, I mean, did we cover all the challenges? These were the three main challenges then we have.
Yeah, I think we've covered the main performance drivers.
Okay. And so what about
the last one? The last one would be inflation, but it's out of the hands of both investors and managers.
Indeed, it's another aspect that influences performance. Okay. So what's the results then right now?
So I will share a couple of slides graphs that I extracted from the report.
Yes, and for the audio listeners of the podcast that is going to be released later, let's review this. Let's explain it well verbally.
Okay. I'll comment on those. So what I'm showing now is the long-term real net return of insurance, pension insurance, so both Pillar 2, the occupational assurance group, and the voluntary pension insurance, so your traditional life insurance that you would subscribe yourself. That's Pillar 3. And what I'm showing on the left-hand side of the slide is annualized returns. We have cumulative returns on the right-hand side. So I think what we see, the calculation we make of this real net return of insurance-based pension savings, we compare that with a simple hypothetical portfolio of, half equity, half bonds, and we base that on two market indexes of pan-European equity, pan-European bonds. So it's rather a conservative benchmark, because if you put half of your investments into bonds, you get a lot of stability, a lot of security, even in a downturn, except in 2022, because the bond market crashed as well. But so it's not a very demanding benchmark to pass.
Yeah.
And yet we see that the returns of both Pillar 2 and Pillar 3 pension insurance are actually failing to beat that benchmark. So one thing that we see immediately with the annual returns is that the big losses of our benchmark in 2022 are much larger than those of insurance contracts. So in a market downturn, you're heavily invested in bonds, life insurance is actually protecting you against those crash. But look at the returns for 10 years or for the 20 years of the whole period, see that our benchmark is not particularly performant, and returns are not extremely good. So that's after inflation, but still it's better than the long-term returns of the life insurance.
Okay, let's come back to this a little bit. So obviously, when you look at the performance of pension products in Belgium, providing just an annual return is one piece of information, and that's probably what the insurance is going to do, right? Oh, no. I mean, in the vacuum, basically saying that on average, those pension products do 1.2% a year, or 1.8% per year. This is real returns, right? This is net of inflation. Is that correct?
Yeah, net of cost and inflation.
Okay, so that's already a pretty good number. I guess it's hard to find this from the providers themselves. So it's already fairly good news that it's positive, that it beats inflation, and that over those periods of 10 plus years, so 10 and 20 years, we have a net positive return for both one part of Pillar 2 and one part of Pillar 3, and those that for which you have the data, right? I guess.
Yeah.
And then you compare this to a benchmark, which is a very conservative benchmark. So you said 50% pan-European bonds, 50% pan-European equity. It's conservative in two ways, right? It's conservative because it's 50% bonds. And in fact, for most people who are accumulating for their pension, that's probably too much fixed income, especially that this is not a portfolio they're managing themselves. This is money that is locked there, and they will not be tempted to sell in case of a market crash or a market downturn. So it's extremely conservative for the accumulating period. But then I don't know, in the actual retirement period, in the withdrawal phase, then that becomes a bit more relevant, like at 50-50 or somewhere around 40-60 or 60-40. So this benchmark seems good for those who are in retirement, not so good for all those who are contributing, right, or accumulating.
Yeah.
So that's one way it's very, very conservative. The other way it's conservative is that it's European equity and European bonds, which
we don't have any exposure to emerging markets or frontier markets. It's purely European.
Or the United States, or so obviously as index investors, we have the option to invest in the entire world, and the simplest and most effective way, the way most of us do it, is we invest in a simple global ETF that covers the entire stock market, for which then Europe becomes a small part. It's like 20% of the overall equity market. And we have then the rest of our portfolio, it's all over the place, a lot of it in North America, but then also a lot of in emerging markets. And then certainly in the past 10, 20 years, returns have been much better outside of Europe than within Europe. So these are two ways, right, that we see a very conservative benchmark. And I guess it makes sense because the products themselves, they invest within those constraints, right?
Yes, exactly. I think I've talked earlier about, our dilemma of making a report for the public or for policymakers. We have the same dilemma with the benchmark. I mean, we've already talked about, whether the accumulation phase or payout phase, we should not have the same benchmark because ideally we should change the asset allocation. And definitely, we're always asking ourselves whether our benchmark should reflect what an individual investor, with or good information, appropriate financial literacy would do to maximize their returns. We probably go for more beyond investments beyond Europe. But at the same time, we want to have something that is a fair comparison with what the pension manager can do. And many of them, not all of them, but many of them face constraints in terms of the universe of investment opportunities you can take. And there are very strong constraints from the prudential regulation in particular to have them invest in bonds, in sovereign bonds, especially in Eurozone sovereign bonds, when it's not even in the national sovereign bonds. Same with equity. We have some constraints to invest in the local markets. For some European countries, it would be totally irrational to limit it to the national equity stock market because those are too small. Think of countries like those in Eastern Europe that have very small, very limited stock market. So in general, it's rather EU funds, EU assets. But I definitely concur with you. If we were to compare to, for an individual investor choosing whether to invest in a life insurance in the Pillar 3 or go for your own investment in ETFs that you manage yourself, you definitely will not at this benchmark if you were to invest yourself.
And I think, we discussed this before the call, but now that we discuss, I think I would like to see the other benchmark as well, if my voice has any weight in this, because this one is almost too nice for the industry. And the other one is a bit more of a real world, real case scenario without constraints that we think are unmovable, because those constraints are movable. These are part of the changes that need to happen. If we accept them as part of a benchmark, then the incentive to make them, to have those changed is lower, I think. And if we want to provide, and then, you can provide two benchmarks saying, look, this is the real world benchmark. This is away from all constraints. This is what could be achieved. And in fact, people are achieving this, me and the rest of the index investing community. This is what they're getting. And this is what you're getting. And here's a benchmark with some of your constraints. And look, even within this very conservative benchmark, you're failing. And I think that gives an interesting idea. There's one, you could do better within the constraints. And two, without the constraints, here's how much better it could even be. I think that would be an interesting numbers to show and to publish. Obviously, they're not going to like you for it, but that's okay, I would say. I mean, I'm hoping you're okay with this. It's part of
That's definitely okay. They already don't like us. So.
Okay, so.
But yeah, I've said earlier that the work thing is I'm working at the moment with Risk Report is making it more interactive, and that's part of the things that I really want to
yes,
compare your real returns of our pension products with different benchmarks based on what the settings you choose, and that I think is something that will come very useful both for policymakers and for individual investors to be able to compare. What is the performance that you could get if your pension manager actually used the space that they have within the constraints at the maximum to get the maximum performance they could within the legislation, and compare it also with what you could achieve with your own investments self-managed. That comes with a few challenges because then we have to make it realistic in terms of also the cost of as the investment platform, the cost of the funds. But indeed, that's direction of travel.
But I mean, in fact, the work you've done is already useful in both ways. It's useful because it shows that we have a positive real return. So it reassures all the people who believe that those pension products are useless. It's like, no, they're not completely. And then it also shows that there is underperformance compared to a very conservative benchmark. So there's room for progress.
Yeah, just one last comment maybe on the returns of insurance. I think on the cumulative returns that we see that the benchmark as a return in 2022 of 50%,
Yeah.
slightly higher than the life insurance. But look at the performance that it achieved in 2021, so before the market crash. It was very much higher, close to 100%, above 90%.
Yeah.
Was roughly the double of that.
Yeah, so in
But
fact, it would be good to see what the data from 2024 and 2025 will show, because obviously 2022 was sort of a disaster year for the stock market. So yeah, one is we want to see the updated when that's available. And two is, do you know how to explain this difference in the drop? Like one drops, by almost a third, but it's not as significant for the pension products.
well, the difference is the exposure to equity. I mean, with the benchmark, you have the double drop of both the bond market, close to 20%, and the drop of the equity market, also phenomenal in 2022. So it combined to create a perfect storm.
Okay.
The drop of the pension products was at branch 21, so basically all invested in bonds, capital guaranteed. They still dropped because of the drop in the bond market, but less than a full exposure or half exposure to equity market.
Yeah.
Maybe I can show you the next slide with the results of the pension fund. So there we have a product that doesn't have a capital guarantee, a minimum return guarantee, and we see that the returns, both annualized and cumulative, are much more correlated with that of our benchmark. Because basically the asset allocation of those funds is very close to this 50-50 benchmark. They have 49% invested in bonds, 30-something% in equity. So the movements of the capital markets are really reflected in their annual returns. Interesting to see is that the performance, so we don't have exactly the same period. We have more data for pension funds than for life insurance. But we see that we have this big drop in 2022, and it's the same for the product and for the benchmark. And then we have a strong recovery in 2023.
So you have more data for this one
than
for...
I think the National Bank of Belgium probably published recently the data for life insurance in 2023. I would not be surprised if the recovery of insurance products was slower than what we saw for pension funds, because this recovery was dramatically driven by the equity market in 2023, not by the bond market. And I think that's the point to solve. More exposure to equity. You have more volatility, good years, bad years, but after any crash, you have a strong recovery.
Yeah.
Of course, with a product like that, if you don't have a glide path, a life cycling approach, and the market crash occurs 2 years before your retirement, you're screwed because you lost a lot of your savings. So that's why you need this long-term approach of life cycling that gets you out of the risk, in time to secure your retirement income before you will actually need it, and so that you don't take your retirement just at the moment the recovery of the stock market starts.
You mentioned that you had some information to share on the Swedish pension fund. Is this?
Oh yeah, okay. So that's a very, I think, probably dramatic graph of the performance of all the data that we have in the report. So it's the annualized performance of all the products we analyze over the maximum periods that we have. We have some products for which we have very short time period. For Belgium, we have 21 years of data for insurance. So I show here branch 21 and branch 23. Just forget branch 23 because National Bank of Belgium does not really differentiate. And we have the data for 24 years for the funds. And you see with the exceptions of the Swedish Pillar 1 bis and Pillar 2 funds, generally, Belgium is not actually doing so bad compared to other countries. I think we have products with minus 1.5% annualized returns, minus 15%, minus 1.1% for some. So having positive real net returns is already an achievement in terms of pension savings. But if we compare that with the achievement of the Swedish pensions, it speaks for itself. It's possible to generate strong returns on pension savings.
Yeah, so this seems like it's a great example for other countries to follow.
And so
Yeah.
in Sweden, the general philosophy is first life cycling approach, as I explained, and also an exposure to global equity markets, not just European. So they invest globally. Actually, all the talks nowadays of channeling individual investments to European firms is worrying for them because they have a strong exposure, and that's one of the pillars on which their strong performance rests. So if the political powers decide to limit their investment universe to only EU, they will have a big problem. Now, so those are already big differences, but analyzed. Now, if we look at the situation, cumulative returns, you see those small annual differences accumulate over time, and over the 23, 24 years, we have a dramatic difference. Whereas AB7 so far of Sweden actually multiplies your savings by 4.5, while your Belgian IOP is actually only increasing it by 40% at most.
Now,
Of course,
this diagram is incredible. It shows how much we are missing by having all those constraints and challenges, right?
Yeah. Now, I think I mentioned that earlier, but there are questions about, the potential excessive risk-taking of AB7 so far. But when you compare to the other funds of premium pensions in Sweden, takes less risk, less leverage, less, a bit more conservative exposure, they still manage to, provide 140% cumulative return over 23 years. So it is possible.
And so I'm guessing there's some good lessons learned from the example of Sweden. What's happening with this? Like, are we learning from these lessons? Are there changes going in that direction? That's one question. And I have another question afterwards on why direct the funds into the European equity market, but that's maybe we go to that afterwards.
Come to that. I think in all the conversations that we have with European institutions, especially with the staff of the European Commission, we see a lot of curiosity for those high-performance products, the Swedish AP7 software or premium pensions. So to see what is the recipe for those high returns. I think they already kind of know, and that's embedded in the design for the Pan-European Pension Product, the PEP. So this life cycling approach, low cost and high exposure to equity. But now the discussions nowadays is more about investment savings accounts, making it simple for individual investors, for anyone to start investing, to have a simple container for all your investments, be those voluntary life insurance, shares of a pension fund, or shares of ETFs, or whatever you might buy as financial securities, and have an easy way to monitor the performance of those investments, the cost of those investments, do your tax reporting. So making it simplifying the investor journey. That's a big part of the thinking on the savings and investment union. If we want people to invest, if we want all Europeans to invest as if they were Swedish, we need to copy the simplicity of the Swedish investment account. So nowadays, in really those weeks, that's more the topic of discussion, more than actually pension saving products themselves.
Yeah, that makes sense. And so the second question was related to the willingness to funnel than pension savings into European equity markets? Because to me that seems to be it's counterintuitive in the fact that, in the sense that it's just gonna make the market more expensive. It's not necessarily gonna make, you know, like the companies that are in the market more productive or more performant. It just makes them more expensive. So what's the rationale for trying to move, well, or funnel the money into the European market?
Yeah, I mean, the rationale is related to the competitiveness agenda of both the European institutions and the national governments. They want, you know, more economic growth. So for that, they want their SMEs, especially innovative SMEs, digital, you know, tech things, to scale up, to start up and scale up. And for that, you know, they realize that any innovative startup in Europe would start in Europe, but then would go to the US for scale up. And so their thinking is, we need the financial intermediation in Europe to channel the big part of savings of European households into those European firms that need equity investment.
So that's not necessarily the stock market then. That's more private equity and those sort of funds then.
Yeah, that's part of the thinking. And so part of the thinking for that is revive the securitization market. We have our doubts about that, and definitely that's, you know, not really something for retail investors. The other part is private equity, venture capital, business angels, that kind of stuff. And another part is also create investment funds that would invest into listed SMEs, into, you know, defense, the equity of companies active in defense, in tech. So all those strategic sector of the European economy. Usually, so in our responses, in our communication on savings and investment, you know, we tend to warn against, you know, those political motivation to choose investment target, and really want that any, you know, channeling of investor funds should be based, you know, the decision where to invest should be based on economic fundamentals, on good returns, level of risk, and, you know, a good match between the time horizon and the level of risk, not on you know, what sector is defined as a strategic priority by its political power.
Yeah, that makes sense to me as well, because it's different. Like the objective is different. You can't like if the objective is to support specific sectors, then that's money that comes with a different set of risk and reward ratio, and that's not what you want to do with people's savings. It's a bit of a, but yeah. So I understand why you have that perspective, and I think that's the right perspective. I guess there's maybe, yeah, there's political things at work here, and maybe misunderstanding of how I don't know. Anyway, that's probably beyond what beyond my level of understanding of how politics in that area works. But it's good to see your perspective on this.
Where that also relates to you know, the topic of our discussion is that there are proposals to link tax incentives for pension savings to the direction of the investment. So have tax incentives conditional to investing into EU firms or into EU bonds. That's something that has been floated by several national governments. Well, that we find quite dangerous. Of course, you know, the tax incentives should be linked just to people making contributions to pension savings, and then let them choose what product they want, where they want to invest based on their assessments, based on good financial advice if they need it, but not on what is, you know, what has been decided should be for them the direction of investing. So again,
yeah,
broad discussion.
Makes sense. Sébastien, this is fascinating, and I'm the first one to benefit from everything you're sharing here. One question, of course, that a lot of people are asking, and that we are asking you now is, so what can we do? What can people in Belgium do to have better pension, like knowing what we know now, or knowing what you know?
So I would, for me, there are five things that we can all do and we should all do. Is first, we basically start questioning your existing pension plans. I said earlier that for a very long time, I had no idea about my own pension savings, especially, the occupational pensions that are made on your behalf by your employer. Most people vaguely know that they have a pot of savings for their retirement, but they don't know, their performance. They don't know where it is. They don't know whether it's a big pot or small pot, and consequently, they don't know what action they should take to complement that. So start asking questions. It's never very comfortable to discuss money with your boss or with your colleagues, but it's essential. I mean, it's part of your remuneration. It's part of your future. So really start asking a question. Start also questioning your bank advisor if you have a voluntary pension plan, life insurance. What's the track record of that? Is it a good investment? How does it compare to other funds, to the rest of the market? Seek information that allow you to assess the performance of that investment. And in that sense, what we at BETTERFinance and with our national member organization try to do is to make resources available for people to start asking the right questions. And I'll start asking the difficult questions also. Asking your advisor, who pays you for giving me that advice? Is it me? Or is it, the provider that wants me to buy that product? So second point, actually seek independent information and financial advice. It's nobody wants to, after their workday, to start reading the financial pages of a newspaper or start finding information, going to Google Finance and see the track record of different funds, especially not reading the key information documents on all the products available on the market. Those are very unfriendly documents to read. But I mean, we need to have that information about the performance of products, about the different risks, whether they are appropriate for us to make informed decisions. There are good resources available at organizations at the national, at the EU level. So they are in French, they are in Dutch, in English. And if you find information in a language that you don't understand, just go to Google Translate and try to understand it. Third thing that you can do, pretty probably, is try to invest in products that are as simple and low cost as possible. They should always meet your needs. So if you need to cover a specific risk, make sure that the product you invest in covers that risk to the extent that you need with that risk to be covered. So it's also a matter of planning your finances. I mean, understand clearly that you don't necessarily need to have 100,000 euros on your bank savings account because you will never face unexpected expense for that amount. Probably you need a smaller rainy day fund and then a good health insurance and then life insurance maybe, and then invest, all the money the rest of your money in other assets that will yield a good return for low cost. So, make an inventory of your finances and see what you need to set aside in liquid bank accounts, liquid products, things with a capital guarantee, and then invest the rest for the long term in low cost, simple products. Once you've done that, monitor the long-term performance of your investment. I don't mean spend your time on your smartphone, looking at the daily performance of the funds you've invested in, but regularly, check what has been the performance of the past month, the past year. See, was it a good investment? Do you need to be diversified? Are there better investment opportunities? Just, monitor that. And if you don't do it yourself, find someone you can trust to do it with you, not for you, but with you. And I would finish with a pro domo appeal. Get involved with consumer organizations, with investor organizations in your country. And in Belgium, there is no national organization in the French-speaking side, expect for policyholders, for pension savers. On the Dutch-speaking side, there is an organization of retail investors that are focusing more on shareholding, fund holding than on, pension savings. But, they are there. There is also, Testacha, general consumer organizations, but also monitoring those issues of financial regulation, financial returns. There are organizations like Financité. All those resources are there. Those are organizations that organize regular events to inform people about finance, about the financial system, about financial savings. Those are resources, levers that need to be pulled.
Amazing. So in summary, challenge the pension that you are supposed to have access to, so especially Pillar 2 and Pillar 3 through your employer and through the product providers. Question your bank advisor or financial advisor, seek independent information. And then it's more moving towards Pillar 4 then, looking at investing in simple long-term products, like index funds, probably ETFs. Plan your finances, and then monitor long-term performance, nothing with the short term, and then connect with like consumer protection associations to get support and all that.
I think the first step for most people is really the this exit one. When they start asking the first question, where is my money? Where is my money invested? Then it really leads to further question. Why is my money invested there? What has been, what is the yield? Can I rely on it? And that leads you then to see whether it's, the answers are good, reassuring, will rarely be. And if they are not, then what should I do? And that leads you indeed to maybe change the provider of your pension plan, so still in Pillar 2, Pillar 3, and then indeed move into Pillar 4, do your own investment, manage them yourself. I think also it's not possible in every firm, in every company, but if you work in a small firm, discussing with your colleagues and with your management the choice of the occupational pension provider is possible. It's not a discussion that is frequent because it's nobody's job to monitor. In most companies, not their job to monitor the state of the occupational pension plan, but it's a collective investment and it should be a collective discussion. I mean, we at BETTERFinance, we have had this discussion recently about, is our provider satisfactory or not? It was not, decided to change. And, that's a discussion that involves not only the management, but also the team. Of course, that's our job to talk about finance, so it's easier.
It might be easier for you guys to do this, but it's a good recommendation. For smaller structure, usually there's more flexibility. Yeah. Amazing. This has been amazing. I haven't checked the chat, but I will do so now. If there are any questions from the audience, do we still have some time, Sébastien? Is it still okay for you?
Yeah, that's fine.
Okay, so if you have any questions for Sébastien, it's a good time to post in the chat now. If you posted before, feel free to post it again because I'm not going to go through the 45 previous comments. All right, there's one question from LM that was posted just now. How would we go about comparing the returns of Pillar 2 pension against ETFs over a certain number of years, net of cost and taxes? I'm interested in understanding if I'm better off putting my extra money into ETFs or into a voluntary pension. That's a good one.
Yeah, that's a very good one, a very tough one also. I mean, a problem with Pillar 2 pension is that usually individual scheme members, so individual employees, do not have access to the track record of performance. But I see Mattis commenting. Mattis is actually the person at BETTERFinance who manages our occupational pension. So we will know the management. There is always someone in your firm that has access to this data or the pension plan provider. So that's why I recommended also talking it internally within your firms. Start asking questions internally to see, is this data available? If it is available, could I have access to it to understand it? Because at the moment, I think there is a database in Belgium of occupational pensions, but there is no public access to it. So as an individual, you can't access the track record of pension plan providers. You can only go to mypension.be and see the pot of money that is there. So if you have all your payslips and your contracts, and you can reconstruct all the contributions that your employers have made on your behalf, then you can more or less see what has been the track record. It's complex. It would require some good command of Microsoft Excel or Google Sheets to do that, but it's possible. At the moment, there is no user-friendly way to do it. It's much easier to do it with Pillar 3 products because there is an obligation for the provider to actually give you a track record of performance. Usually, they give that in the mobile app or the web app. The balance of your account with them at end of each month or end of each year. So it's possible to calculate an internal rate of return. Also, in my work plan, I'm trying to develop a calculator of the internal rate of return and track record. Big challenge for me, but when I said go to consumer organizations and try to see what resources they have, that's the kind of idea that I had in mind. I think I'm not the only one working on that, so probably several people. And then getting returns of an ETF, it's quite easy. A lot of websites that reference the evolution of financial products, including ETFs or including market indexes that ETFs are tracking. So once you have the track record of your existing pension product, comparing it with an ETF, it is quite simple. That's the easy part of it.
Yeah, and I guess for Pillar 2, it's hard to get the data, is also what Mathis is saying in the comments. For Pillar 3, you can get the data more easily. We had actually an event about 6 months ago with David Liégeois, who's in the comments here, looking at the comparison between Pillar 3, Épargne Pension, compared to index ETFs. And the conclusion is that for most young people, if they know how to invest in index funds, that seems to be the better option. But for people who are over 45, 55, then there's a case of having money into the épargne pension and pension savings because of the tax advantages that basically work nicely on the short term, but the high fees kind of can be counterproductive long term. So that was, brief. If anyone is interested, you can look it up on YouTube. It's a conversation with David Liégeois on pension savings versus index investing. Yeah, so it's there. Is there, this is another question from Tail. Is there a good provider for Pillar 2 products? He wants to nudge his company towards better products. And there's a comment from David Liégeois to look at EasyVest because they recently opened the product for SME recently. And yeah, EasyVest is a famous index investing pension product provider in Belgium. Do you know of that product? Do you know of other products that would be useful to Tail or anyone listening to this for their employer?
I know of EasyVest. I don't know of any other provider in Belgium. I know that the business model of EasyVest is providing occupational pension plans invested into ETFs is actually something that is popping up in different European countries with different names, but usually that's the idea of having your occupational pension wrapper around investments into ETFs to limit the cost so that it becomes available to smaller sized structures without the more standardized way of going about it. Now, I don't know any other specific providers. I'm actually not certain that legally I could mention them, whether it would amount to...
Well, I mentioned them, so you didn't. Let's say I mentioned them, no problem. No, but we know of them in the community, so this is a comment by David as well. Okay, any other questions in the audience? Okay, so if there are no more questions, Sébastien, do you have any questions maybe for us, for the audience, or final thoughts, comments?
No, I'm really looking forward to the next sessions, next discussions with and others to know more about the other pillars and complements. I mean, I just wanted to mention that, as I said earlier, this research on pension and gathering all this data is is a lot of work. But we know it's insufficient. So if any member of the community wants to, give us real world examples of, problematic products or conversely good products that, they think should be promoted or, should consider best practices in Belgium, happy to hear from them. You can always send us an email and happy to start a discussion about that.
Amazing. And the email they could find out on the website, betterfinance.eu, is that right?
Yeah.
Okay.
You have a whole list of all our emails. We have a policy at betterfinance.eu email address that's, for contacting me and my colleagues working also on digital finance, on sustainable finance, cover a lot of ground. I'm the pensions guy at Better Finance, but we cover a lot of other topics as well.
Amazing. So if anybody knows, anyone who's listening to the recording as well, of good pension products, good practice, interesting examples to send to Better Finance, then email that at policy@betterfinance.eu so that Sébastien and his team can then look at it and improve the work they do and use it as example for others. Yeah, amazing. Sébastien, thank you so much for your time, your generosity in your time and sharing your knowledge.
Thank you for your invitation. It was a great discussion. I enjoyed it very much.